Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a consolidated statement of cash flows using the indirect method. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to enter that into the blue area on the right-hand side. Let's take a look at what we have. We have P purchase percentage of S, P the parent, S the subsidiary, January 1st, 2000 X 0. Common stock, that's going to be the 75%, so we got a breakout between parent subsidiary, 75% parent, 25 subsidiary. The purchase at book value, so that means that we don't have any differential we need to deal with here. The fair value of the non-controlling interest is 25%. The consolidated trial balance as of January 1st, 2000 X2 and December 31st, 2000 X2 are on the right. We're going to be using this consolidated trial balance in order to build our statement of cash flows using an indirect method. So in other words, we have the trial balance as of the beginning of the year, or you could think of the end of the prior year. We have the post-closing trial balance for, basically the prior year trial balance. And then we got the current year trial balance as of the end of the current year. And then we'll use that for our worksheet to make our cash flow statement. We will be making the cash flow statement using the indirect method. The dividends paid for the current years are going to be parents' dividends, $35,000, the subsidiaries' dividends, the $25,000. So our worksheet is going to be on the right. Much of this is going to be similar to, a statement of cash flows type of process. We're focusing in on the areas that will be different. Now, the statement of cash flows is an area that I think many people don't understand too well. You might need some, brushing up on the statement of cash flows. We do have a course on just the statement of cash flows and how I would put together a worksheet. Again, I think in public accounting, people often still have trouble with this, getting the statement of cash flows and thinking about how to go through it in a systematic type of way to put together. I think we have a system that's pretty good to do that, so I recommend going over there. Obviously here we're just going to put down the statement of cash flows, mainly looking at those components that are going to be different when we're thinking about consolidations as opposed to the standard business here. So these are going to be the consolidated trial balances for the beginning and end of the year that we're putting into our worksheet, which we'll be using for our statement of cash flows. So these have already been consolidated. And so now we're going to be doing our normal type of worksheet. So typically what I would do is line these up, prior year, current year. Prior year is a post-closing trial balance, therefore it ends at the permanent accounts. Balance sheet accounts doesn't have any income statement accounts. The current year then, we're including the income statement accounts here, so we got the whole thing here. Then we're going to take our difference. So I'm going to take the difference of the current year minus the prior year. So I'm going to say this is going to be equal to the current minus the prior. Now notice I have it green because I'd like to keep the same kind of color coding formatting here. And to do that, what I want to do is make this whole column black. So I have it blue now just to indicate that you're going to have to enter data there. Let's make it black now. I'm going to put my cursor on first cell all the way down to all the blue areas. Let's go right click on that area. We're going to select the paint and make these black. So there we have them. Now I'm going to copy and paste this all the way down, doing the same, subtraction problem all the way down. Now you can't really autofill. If you did, they all turn green. I'd like to make these ones orange. So what I'm going to do is undo that. I'm going to copy this one. Then we're going to paste it, but we're going to paste it just using the formulae. Paste with the formulae, paste with the FX formulas only. So there we have that. So there's going to be our differences. As we go through the statement of cash flows then, I would think about everything in terms of the differences, mainly on terms of the balance sheet accounts. In other words, these are all the differences other than cash. If we find a home for all the differences other than cash, then of course cash will be the end result that we'll get to. And so that's going to be our objective. We want to think about that. And then I would think about any kind of other changes you have to put in place. So the first difference, of course, is the difference basically in retained earnings, which is the net income, in an indirect method that we'll typically be using in our statement of cash flows, where we have cash flows from operating activities, investing activities, and the financing activities. So what we're going to do here is we're going to be taking and picking up then this typical starting point is going to be the consolidated net income. Now that does not include the non-controlling interest. So it's going to include these items, the 89,750. That's one of our major differences here. So it might take we might want to spend a little bit more time on that. So what I'm going to do is I'm going to say this is going to be equal to the negative sum of revenue down to the miscellaneous expenses. I'm not including the non-controlling interest down here. Let's do a little kind of reconstruction because we can think about this number, net income, generally as kind of like the major difference between the retained earnings accounts. So let's just kind of do a little recap to think about this difference to help us out with our cash flow statement. If I was to take the differences in the retained earnings, this is the retained earnings for the prior year, this is the current, and this is the non-controlling interest, and then this is what's happening in the current year. In other words, this is the prior year, and this is the current year. Net income has not yet rolled into the retained earnings yet, so that means that all of this net income would roll into retained earnings. So let's say I took all of the equity accounts over here. I'm going to say this is basically all of equity differences, the differences in all of equity. You can include common stock or not because it's, you know, the same from one year to the next, and that would be 48,500. And then let's kind of see if we can reverse back out to the point where we're going to get to this number, and that'll help us to think about our differences. So, you know, if I'm just thinking about these numbers, what's not included in this major difference in the balance sheet accounts? You know, this is the major difference in the balance sheet in the equity section accounts balance sheet account. Well, one is going to be that non-controlling interest. So I'm going to say negative of that. That's one item there. And then we have the non-controlling interest in the net assets, which is that 4,000. So I'm going to say negative of that one if I pull that out. And then we have this 35,000, which is a result of our consolidation, and it's the dividends. So the dividends have been closed out to the retained earnings here. So I'm going to be picking up those dividends. I'm going to say negative of that 35,000. And then that's going to be our total. So let's go ahead and sum that up equals the sum. And that's going to get us to our 89,750. So there's the 89,750. So we can think about, you know, the change in kind of like the equity section in these terms, and then once we do our statement of cash flows, try to figure out how that fits into how that change fits into the statement of cash flows. Because again, I would think of the statement of cash flows as the changes, especially using the indirect method, as the changes in basically the balance sheet accounts, the net income, or in this case, consolidated net income, basically the change in the equity section. So that's our kind of little reconciliation. Then we're going to look at the depreciation. We usually pull out the depreciation and then the changes in basically the current asset accounts. So again, depreciation, I would think of it as first let's say, depre expense. I'm just going to try to copy and paste as much as possible so I don't, I would think about that in terms of the difference in the accumulated depreciation. So there could be factors where the difference in the accumulated depreciation is different than depreciation expense, like sales or purchase of equipment or something like that, disposals. But I would first think about it as this change and then go back in and see what kind of other things have happened. So now here it happens to be the same, right? The change in the accumulated depreciation is the same as the depreciation expense. Why? Because the only adjusting entry was the adjusting entry for the depreciation expense. So what I would do then is take this one. I'd say, okay, I'm going to be picking up this change in the accumulated depreciation, the change in the accumulated depreciation. And then I'm going to mark that off and just say, all right, we found a home for that one. Like I say, if it was different than the depreciation expense, I would still pick it up from here and then go figure out how I would fix it later. So that's the approach I would take for basically this whole thing. So I know how to get in balance first and then go and fix it for those items that are not matching up. Same with the amortization. If I have the amortization, that should be the change in the intangible asset here, because there's no accumulated amortization, which is the same here as it is here. So again, if we sold something or something like that, it may not be, but in this case it is. And I want to think about it not as something I pulled from the income statement, but as a change on the balance sheet, which is kind of backing into what is happening on the income statement. So I'm going to say, and notice I'm always saying negative of these numbers. So on the way the worksheet's set up, I'm just going to say negative of the change is our typical process. So we found a home for that one. So I'll put a little yellow box there. Then we've got the changes in the operating assets and liabilities. So I'm just going to go straight through these. We've got accounts receivable. So accounts receivable has this change that is happening. Now I'm going to use the standard rule, which is just basically I'm going to take negative of that number, or in other words, if accounts receivable goes up, it's going to decrease this item, and if the payables are going to be the opposite, assets and the liabilities are opposite. You can, again, if you want to think about more why that is the case, you can take a look at our cash flow course there. It is really worthwhile to kind of mull over those kind of things, because if you can really understand the cash flow statement, then you're kind of backing into the financial accounting. You have a good concept of financial accounting concepts if you can do that. But here, the general rule is we're just going to apply the general rule. So I'm going to say this is going to be negative of that 16,000. And I'll put a little yellow thing here saying we found a home for that one. There's the 16,000 there. We're going to go to the inventory now. Change in the inventory. It's a current asset. Therefore, the other side's on the income statement. So it's going to go in the operating activities. I'm just going to say negative of that 8,000. And then I'm going to put a little yellow box there saying we have found a home for that. Then we're going to take the change in the accounts payable. Jumping on down to the accounts payable, and you might go, well, why didn't I do land or the machinery? Because the changes in those are long-term assets, and therefore they are investments and not the other side of them. In other words, if you think about them, if you purchased machinery or sold it, then the other side generally isn't on the income statement, except for a gain or loss that could result from it, right? But it's going to be an and therefore it's not in the operating section. It would be in some other section, which would typically be in the investing activities. So the next one that would be in the operating are going to be the current liabilities, which is going to be the accounts payable. So I'm going to apply the same rule, saying negative of this number. Now note, because I'm using debits positive, credits negative, this number is a positive number over here, representing the fact that the liability went down. So the liability went down, represented by this positive number, and we're making it negative because on the cash flow statement it's kind of like the opposite of the assets. If it went down, we're actually going to decrease it. If an asset went down, then we would increase the asset. Okay, so then we're going to go to the wages payable. Same thing there. It's another liability. I should put a little yellow box by this one because we found a home for that one. That's what we do. That's what we've been doing. So then I'm going to go to the wages. Same thing there. I'm going to say negative of that 24.4, negative of the 24.4, and then we have that, and I'll put a little yellow box by that one too. So we'll right-click, yellow box. Okay, so then we're going to have the cash flows provided by operating activities. This is going to sum this thing up. The notes payable, again, obviously not current because the other side of the notes payable isn't typically on the income statement, as the interest income possibly, right? But so that means it's going to be somewhere else, a financing activity, typically that change. Then I'm going to sum this up. Make sure you sum it up all the way to the top, all the way to the consolidated net income, and that'll give you our 102,250. Now we're going to go to the investing activities. I'm going to pick up our change in the land and the machinery. So I'm going to say that change in land is going to be up top. Now the land went up, so you would think that would result in a purchase in land. Now obviously in practice we would want to go to whichever company, had an increase in the land and just check the journal entry to see if it's going to be more complex, something more complex happened. Usually property, plant, and equipment, there's not a lot of activity going on in it, so we can see there's only going to be a few journal entries in there as compared to like cash or accounts receivable if we look at the general ledger. Therefore, we can go in there and just drill down on those transactions. But it looks like we're going to say cash, we purchased land because land went up, so we're going to assume we purchased it with cash. Here, again, it could be a more complex transaction than that. We want to double check it, but that's what we're going to record in our statement here. And even if it were more complex than that, I would still record this first and then kind of make a little note that I want to go back to it, find that transaction, and then make any adjustments afterwards after I've already reconciled this thing. Then I'm going to go to the purchase of machinery. Let's say we're going to say purchase of machinery. Same thing here. I'm going to say, well, the machinery went up. That means I'm going to assume we paid cash for it. Now, again, I could be more complex than that. Something more complex could have happened. but I'm going to assume that that change is due to that, and then I would go back to that general ledger account later, look for those actual purchases, decide if it's more complex, and make the change after I've already reconciled. If I just use the change right now, I can reconcile. If I make things really complicated and try to, look at all the pieces as I go, it's going to be harder for me to reconcile, because I can't. If I'm already in balance, I can go back and I can figure out all the little pieces that might be involved in the purchase of the equipment, like a loan or something like that. Whereas if I'm not in balance, then I'm not sure if it's, I'm less sure if it's right. So I'd rather get down to my cash flow statement balancing by just taking the change, and then I'll have that extra check to figure out something like the sale of equipment or purchase of equipment in more complex situations. Okay, so then we're going to have the net cash used in the investing, and I'm going to say the sum of these. So we have the sum of those, and then we're going to go to the cash flows from the financing activities. So we've got all these financing activities, cash flows. We have the note that we have. We have a change in the note. So I'm going to pick that up, and I'm going to say this is going to be negative of this number, the 15. So the note went up, so we got the 248. So that we would assume then that we purchased, that we got another loan, right? Loans went up, so cash received in the loan. And again, that could be more complex. It might be more complex than that. That notes payable could include multiple notes that had stuff going on in it, and we'd have to go in and look into it. But I would use the first change first, and then if it is more complex, go back into it and pick up more detail on it. So then we're going to go to the dividends. So I got dividends paid to the parent shareholders, dividends paid to the parent shareholders, and that's going to include this 35,000. So I'm going to say this is cash going down. I'm going to be picking it up here, or I can pick it up here. It's part of this change, the 35,000, or we might want to pick it up down here, part of the dividends down here as our reconciling thing. That might help us to see where these are coming from, because this is going to be part of the change that basically is in the equity section, the change in the equity section that we're kind of picking up here. And then we've got the dividends paid to the non-controlling shareholders. So dividends paid to the non-controlling shareholders we're going to be picking up. And that's going to be equal to, I'm going to say negative. These are going to be the 25,000 times, and we're going to be picking up non-controlling, or the 25% of them, the 6,250. And so that's going to give us then the, let's say here, net cash used in the financing activities. Let's give that one more indentation, and then we'll sum these up, summing those up. So there we have that. So note that the dividends paid to the non-controlling interest, it might be useful to note down here, if you look at our little reconciliation, we took the 48, this is the change in basically the equity accounts, and then we had this item, which basically isn't included up top in our cash flow statement, and this item, which basically you see aren't directly going anywhere up here. If you were to sum those two up, there's that 6,250. So there's the 6,250, and then of course we have our dividends here, our dividends of the 35,000 being reflected in the dividends paid, parent company dividends. Okay, so then we're going to say that the net cash increase then is going to be, we're just going to sum up this outer column. Summing up the outer column, we're getting to that 31,000. Then we're going to compare that to the cash at the beginning of the year. So cash at the beginning of the year is going to be on the beginning trial balance. I'm just going to say that that's going to be equal to the 79.5. And then we got cash at year end then. Cash at year end then is going to be the sum of these two items, and that's going to be the 110,500, which of course should match this amount and the amount on the balance sheet. So there it is. Most of the cash flow information is going to be, similar, but and this was not a complex cash flow statement, so you could get more complexities in the cash flow statement. But just note, this is one of the major things we're going to be accounting for, of course, is what are we doing with these non-controlling interests and the dividends and whatnot taking place. So that's where you want to concentrate in on. And if you want more information on cash flow statements, again, we got another course on that.